Craig, what's up, buddy?
What's going on, Brad?
We are live all over the world right now. Hey guys, what's going on? It's Brad and Craig here. We took a little hiatus last week, as some of you guys know. Real estate convention was the middle of last week. Craig was down there taking part in that big fight at Harrah's. If you guys,
I was not at Harrah's. The funny thing is every year I've gone to this convention, I've gone to Harrah's, and for whatever reason, this year I didn't go. I went to Hard Rock, and I saw that video too.
Dude, I've been telling everyone, when you mix the locks and alcohol, you're bound to have fights, and that's the one major difference I think this year versus previous year.
No, but the locks played at Borgata, not at Harrah's.
Well, people ended up at Harrah's, you know that.
It's possible. I don't want to say nothing's impossible.
No, I'm
just kidding. You're there to have fun. You shouldn't be fighting on a time to relax. So
it's crazy. Yeah, you're right, dude. So, all right, guys. Well, listen, today we want to talk about the Fannie Mae Homestyle Renovation loan. And this is kind of like part 2 of the renovation product guide here. And we kind of talked about, we talked for very long about the FHA 203K loan. So today we're going to try to keep it short. We're going to go over, I guess, 3 main things. Is first, what's great about this loan in this market? Like, what's some of the reasons you would use this product? We're going to talk about exactly what it is, the specific requirements and how you can use this loan. And then we're going to go over the major differences between this product and the FHA 203K loan that we talked about a little over a week ago. So first, I just want to mention that you use this product, this Fannie Mae Homestyle, just like you would a 203K loan. It's either to make renovations when purchasing a home or when refinancing a home. And I think in this market, a lot of people are considering selling their home and buying a new home for multiple reasons. Number one, because of their equity position. You can sell a home for a lot more right now than you could have a year ago, 2 years ago. So they're trying to capitalize on that equity position. But the one thing about selling your home right now is you're going to pay a higher price on the next home you purchase. And I feel like a lot of people are trying to sell because of their equity position, but more importantly, because their post-COVID house is different. Like, what they see as their post-COVID house is different than the pre-COVID house. And what I mean by that is that many people spent weeks and months in their home, realizing that certain changes needed to be made to make their home more habitable, maybe putting in a gym, maybe putting in a home office, right? Because a lot of people weren't going into the office. So now what they're looking to do is buy a bigger home so it has those accommodations. And, I think the 203 or the 203K loan or the Homestyle loan is great for renovating a primary residence to make those changes, to put an office in the basement, or turn, an old bedroom into an office, or put a gym in the garage, whatever it is that you want to do. I think it's a great reason to consider this loan, is because maybe you don't need to go out and buy a 500 or 1,000 square foot more house, especially with the tax you're going to pay on it today in this market. So it's a great way to make some upgrades to your house. That's the refinancing part of it. Craig, can you think of any other good reasons?
I think most importantly that this conventional loans are, if you're talking about taking cash out, right? Because that's what the idea I would get if I'm saying, okay, I'm pulling cash or equity out of my home to do something, right? To do renovations. Typically, if a traditional cash out mortgage is going to have a higher interest rate than a rate and term refinance, and you're capped at certain positions in equity, meaning you can only go up to 80% of whatever the appraised value is. Whereas maybe you want to do some things to your property and you only need a small percentage of equity to do a renovation loan. You can go up to 95% rate and term for a rehab loan, for a conventional rehab loan. So where traditionally, where you might be thinking to yourself, okay, I want to do this myself. I want to pull cash out of my house and do these renovations myself. you're limited to 80% of whatever that appraised value is. Whereas the renovation loan allows you to go up to 95% of the after improved value. So, that's just another thought that crossed my mind in terms of what you're able to do, how much more equity position you have in order to build in these items that maybe you're thinking about pulling cash out and doing the work yourself.
Yeah. So, and that's great. I think that's a great valid point to go along with that. So that's the other reason that you might consider this when refinancing, because a lot of people are looking. The first option is to pull cash out, right? So it's a great program to refinance your home. The second thing I want to say is that it's a great program to use when purchasing a home, because right now there's not a lot of inventory. So by getting qualified for a home style renovation loan, or 203K for that matter, is going to make finding a home easier, because now it's almost like you could look at any house on the market, anything that maybe the kitchens or the bathrooms in a house are terrible, but the bones and, the land that the house sits on are great. Then this is a great way to make that home perfect for you. And not everybody is getting qualified for this program, right? I mean, not a lot of lenders are offering it, maybe because they don't know how to do it, maybe because the bank that they work for just doesn't offer it. So the good thing with us is that we understand that we've done a lot of them and we do offer it. So if you're thinking about getting pre-qualified for this product, we could definitely help you. And it doesn't hold you to anything. There's no obligation, there's no expectation. So just in a nutshell, really quick, you'd use this product to make renovations when purchasing or refinancing a home. The second thing I kind of want to jump into, Craig, is talking a little bit about the program. So maybe as our loan guideline expert, you can kind of run through that with us, just some basics of how you use the program.
Yeah. So first I would preface that if you haven't watched 2 weeks ago, the video on 203K loans, I would watch that video, because that's a more in-depth video than we're going to get into with this Homestyle loan. But in essence, the loan allows you you're able to go up to conventional limits. So it's basic conventional guidelines. You can go up to 97% if you're a first-time home buyer, but if you're not a first-time home buyer, 95% of the total acquisition cost. And what that means is whatever the purchase price is, plus the total rehab cost, that would be your total acquisition figure. So for example, if you had a sales price of $100,000 and you had $50,000 worth of renovations, you could essentially go up to 95% loan to value. You could borrow 95% of that total 150,000 acquisition. So just like the 203K, you're able to finance the repairs as a part, or renovations as a part of the loan program. And these items are repaired after settlement. So it's sort of like a one-time close, right? You're setting up the program, understanding what's the work that needs to be done based on a contractor's estimate. And whatever those items are that you're saying that you want to have done or rehabbed, it's the repairs are funded after settlement, but you get the close prior to those repairs taking place. So essentially, it allows you to borrow a lot, a lot more, or it gives you more flexibility, I should say, on inventory. It allows you to more flexibility to have an imagination to buy something that you want. I don't know if you wanted to add to that, Brad. While I quickly glance over.
I mean, I think that's the main thing, is that you're making renovations and you're borrowing up to a certain amount, and the amount that you guys can borrow up to is going to be dependent on how you're occupying the home, which we're going to talk about in the next point, is the major differences between this product and 203K. But depending on how you're occupying the home. So
so let's get into that. I feel like,
well, the other thing I wanted to, before we kind of kick gears, the other thing I wanted to mention is that the 50% of after improved value in renovations, which I guess kind of goes into the next point as well, the differences. But with the with the home style loan, the renovation part can't be more than, like, if you're doing I don't know, $50,000 in renovations and the after improved value is, I don't know, 90 grand, and there's enough to finance all that with what's owed on it or whatever the case is, you still can't do it because the renovation portion is more than 50% of the after completed value. So what you're financing renovations, that amount can't exceed 50% of the after improved value. So again, if it's $100,000 after improved value, your renovations can't be more
your
than
total rehab cost can exceed 50,000.
Yeah,
which is a little bit different than FHA, because we explained in that last video that there's different formulas that are involved. But to go over the good thing about conventional financing, number one, if you have a good credit score, conventional loans are really a very good product for somebody that has good credit and a larger down payment. But another really important part is maybe you're not looking to buy a primary residence. Maybe you're looking to buy a second home or an investment property. These are all things that are only capable under conventional financing, right? You can't use the 203K loan to buy an investment property or a second home, but you can with the Fannie Mae Homestyle loan. So that's also good. You are limited to, a maximum amount of financing with those types of loans. Like, for example, a second home, you can go up to 90% of the total acquisition cost, purchase price plus rehab costs. For an investment, they will only allow a single family home only. So you're unable to do multifamily properties of up to 85%. But multifamily, I believe you can go as a primary residence 3 to 4 units up to 75%. So investment's a little bit more strict. But you can do multifamily for a primary residence. Second home's limited to 90% financing. Investment is single family only, and you can go up to 85% financing.
I think that's awesome, because just on that point, a lot of people want to get into the investment game, and it takes a lot to do. Number one, if you're buying a house as an investment property, they're usually looking for bargain deals, which those houses need repairs made in order for them to qualify for Fannie Mae program. So if you're just doing a traditional mortgage, you're going to have trouble buying that home if it needs repairs, like if the kitchen's all ripped out or something. So number one, this gives investors the ability to look at everything on the market. But more than that, if you're like a newer investor, you might not have the capital to come up with your traditional down payment to buy the house, and then also the money needed to pay contractors and all the people that you're going to be having do the work. So, it's really cool. I mean, for like a first investment property, if you find a house for 100 grand and you need to put 50 grand into it, that's a small amount. You're coming up with what, 22,500 roughly total to acquire and renovate an investment property. It's a small amount. I mean, there's closing costs too outside of that, but before this program, I mean, you would have been required to come up with your down payment and then also the $50,000 needed to pay the contractor to make those repairs. So, I mean, do the math on that. 50.
Yeah, I mean, to add to that too, another really good benefit to doing these types of loans is the conforming loan limit, right? That ceiling has raised, and as of January 1st, 2022, I mean, we're already locking in loans for that higher loan limit because we know we're going to deliver them, once that loan limit hits. But I believe it's 647,200.
Yeah, that sounds
the loan limit, and FHA has a smaller ceiling, right? Your loan limits are significantly lower, right? So maybe there is a larger, loan that you need, and you're able to do up to, that loan limit for with these applicable loan to values for whatever property it is that you're looking to buy. So I feel like that's a good thing when you're talking about this loan versus an FHA loan.
Yeah, I agree, man, because it's FHA, their loan limits are going up too on any case numbers, I believe, filed after January 1st. But either way, they're not going up nearly as high as conventional, because there's probably a $200,000 difference right? And when you're looking in certain areas, that could be a huge difference, because it might be trouble to find some. I mean, I know people that are doing traditional loans that can't do an FHA loan and get maximum financing just because of where they're looking, right?
Yeah, the floor limit for HUD is 426.80, right?
Yeah.
But that's significantly different, right? Over $200,000 different. So
yeah, exactly. So
yeah, one of the other things I wanted to add the differences to, and this goes for a standard FHA versus conventional mortgage anyway, is that with an FHA loan at maximum financing, you're going to pay mortgage insurance, right? You pay an upfront premium of 1.75%. Anything over 95% loan to value, you're going to pay 0.85% of your total loan amount annually, and you divide that by 12. That's how they come up with that mortgage insurance payment monthly. That's usually more expensive than if you have qualifying criteria for a conventional loan and you have a good credit score, even at a 95% loan to value for a conventional loan. It might be half as much in insurance, maybe more. So that's another good reason why this loan might be better than an FHA loan, because you're paying less in mortgage insurance at high percentage financing.
Yeah, I agree, man. And you can get creative too. Like I know a few people that did the renovation product and elected to do the single paid mortgage insurance. And a single paid mortgage insurance on a conventional loan is going to be less than the upfront mortgage insurance on the FHA loan. Which the difference with an FHA loan, you're financing it, right? With the conventional loan, in most cases, if you're doing maximum financing, you're paying it at closing, but you're also, if you do that type of mortgage insurance, you don't have the monthly. So inevitably your payments you're going to finance less with the conventional loan overall because of that, in most cases. And also your payment's going to be less. So it's a great product. And, I'm hoping this is helping you guys, because I think that going forward, we all need to be considering renovation loans, because there's a lot of things that we need our house to have that, me personally, I mean, we're in the process of moving my office or changing my office into a nursery right now. I'm going to be without an office. How many other people that are watching this video, or just people in general, are without an office that could use an office space at home, because they're not going to work anymore because of everything that's going on. They're working from home and they don't really have a place dedicated to do work where there's no interruptions, right? So just something as simple as that. I think it's a great product and people should consider it. They should know about it. Real estate agents, more than ever, should understand this program. And if you're not working with a lender that's knowledgeable with it, or that even offers it for that matter, feel free to reach out to us. Like I said, guys, I didn't want to keep you too long, because we really went into depth on our last renovation live feed, which was about 2 weeks ago. You can access that. It was pretty lengthy. There's not many differences with this one versus that one, except for, like I said, Craig said, is how you're going to occupy the home, the down payments, how much the renovations can be, and in relation to the overall improved value of the home. Just some minor differences, so if there's anything that we can help you guys with, just feel free to reach out. You can email us, you can call us, you can also send us a direct message right here, wherever you're watching this video, whether it's Facebook, YouTube, I don't know, LinkedIn. Craig, do you have anything that you want to add to this?
Yeah, for something that we didn't talk about in the last video, I feel like this is important too, because a lot of people don't realize that you can actually, as a part of these soft costs that I don't want to get too lengthy with soft costs, but there's renovation costs, or costs, I should say, involved with doing the renovations. We talked about the contingency reserve last time, draw inspections, title updates, the ability to reimburse yourself for permits, consultant fee, an architect fee. These are some of the costs involved with doing the actual renovations itself. But what most people don't realize is, if you're displaced from the home, let's say you own the property and you're unable to occupy the property during a major renovation, you can actually finance up to 6 months of your mortgage payment as a part of the loan. So even though you might be, at a hotel or staying with family, when you close on a loan, your payments due, sometimes within 30, 60 days, right? Your first payment, but you might not be living in your home because you have contractors, subcontractors, people running through your house that you're unable to occupy. If you're doing a large addition to your house, you're not able to live in your house. And some of the questions that come up are, do I have to pay my mortgage even though I'm not actually in my house and the work isn't complete yet? And typically you would, but this loan type allows you to finance some of your mortgage payments in that situation if you're unable to occupy the property.
What do they do? 6 months of mortgage payments still?
Yeah, up to 6 months. And I feel like that's like one of those case by case basis, based on when the work is going to be finished. But it says up to 6 months. And I feel like the same thing applies to a 203K loan. So that's good to know, is that, hey, maybe you're not so much concerned of borrowing a little bit more money and having your payment only go up a little bit by saving, a number of payments. That might be more helpful for you to kind of consider, doing a large renovation product that you're not required to have to pay that mortgage right away if you finance some of those payments. So that's something good to know.
Yeah, that is good to know, actually, and it's definitely helpful for if you're kind of squeezing pennies there at the end to get it done. All right, great, man. Well, why don't we just really quick? Why don't we talk about the process, Craig? Like, if somebody wanted to look into this, obviously, I mentioned there's no obligation. So, what does it look like for somebody who wants to consider this idea? Like, what would they do? What would their first step be? And what would the next week or so look like if they were to start the process today?
I think the first thing you have to do is take action and contact us, right? Reach out to Brad or I, and we'll talk to you about getting an application completed. That's the first step, getting an application completed, getting us necessary documents so we can evaluate your eligibility. I feel like the next step after that is having a consultation with me, which my team will, or our team, I should say, will set up that on my calendar so that we can talk about this loan process in more detail and how it might apply to you. After that, it's really, I feel like the most important thing is finding the right people to help you with this. The right team, I should say, help you with this other than financing, right? Who's your realtor? Who's your contractor? I feel like finding a good contractor, and we talked about this, what the best practices are for in that video for 203K 2 weeks ago. I feel like finding a good contractor is so important. So getting that process started, interviewing some contractors, finding out who your family and friends maybe work with that you trust, who they trust to give you an idea of whether they've done this before, whether they can take on a project that you're trying to accomplish. And if once we pre-approve you, once we get through that consultation and we give you an idea, right, we can always estimate a certain amount of renovations and quickly come up with your maximum amount that you qualify for. But once you're ready and out on the street and you're looking for a property that's specific to your needs, a fixer-upper, or maybe it's a property that you don't have in mind, but you're kind of want, like I said in the beginning, be imaginative, right? I don't want the property the way it is, but I want to do this to the kitchen. I want to do this to the bathroom. As soon as you're out there and looking at properties with your realtor, it's having that contractor go along with you maybe and figure out what's the cost of that work, and then circling back to us so that we can give you a more accurate idea specific to whatever property that you're looking at. And then from there, it's potentially making an offer. But, to me, the most important part of the process is getting qualified, getting that app done, us determining your eligibility, giving you some examples of, maximum amounts that you would qualify for, including, the renovation costs, hiring a contractor, hiring a good realtor, looking for a property and then circling back to us so that we can help you, get more accurate ideas of financing terms.
Perfect. And then I guess the other thing that I will add to that is that when you get them pre-approved for this loan product, you're also pre-approved for a traditional conventional loan. So I think that's a misconception, is people think that they apply for one thing, and if they decide against that and they want to go another direction with the type of loan they're using, they think they have to reapply, and that's not the case. We have many different systems that make the process seamless, and we would essentially qualify you for both this and a traditional conventional or FHA loan or whatever you're thinking. That way, if you do find a house that doesn't need renovations, or very minor renovations, and you think that this product really isn't required for that particular home, then we can update you with a different pre-approval letter to make an offer on that house and get you traditional conventional financing.
And that goes with anybody that's looking to buy a house, whether it's rehab or not. It's, we have the ability to qualify you for multiple programs, right?
Yep.
So that hey, this program might be better for me, right? I'm an example, an FHA loan, multifamily, right, is going to allow you for more financing doing an FHA loan. If you're looking for a multifamily primary residence, you might want to be qualified for FHA, but maybe you do have great credit and you also want to qualify for a single family home using a conventional loan. We have the ability to do that seamlessly with some of our software. So
it's awesome, man. Cool. Well, I think you hit all the points, and I'm glad that we talked about this today, because this is an exciting topic for me, I'm sure for most, the renovation product. Lack of inventory. It's a great product to use for that, again, guys. And if you need to make some more changes to your home, make it bigger, put on a small addition, put an office in there, I don't know, whatever you're thinking, it's definitely a great program to help you refinance to make your current home meet the requirements for your current living situation, opposed to going out and buying a bigger home. You might be able to just take advantage of the equity you already have and lock yourself into a low interest rate and make some necessary improvements. Cool. So Craig, I know you're super busy. I'm not going to keep you, man. Is there anything, one last thing you want to add to this, or no?
No, I would just say maybe we can share the link to that other video for people that didn't get a chance to watch that 203K, because it was that video on the 203K, because that was more in depth. But if anybody ever has questions, have a specific scenario, or you just want to kind of go over this in detail, we're available. So email us, send us a private message. We'll be more than glad to help you out and answer any questions that are specific to your scenario.
Cool, man. Sounds good. Yeah, guys, if you guys want to get access to that previous stream we did about the 203K loan, you can scroll back in our feed, but I can also send it to you directly. So just shoot one of us a message and we can get that over. In the meantime, I hope you guys enjoyed this presentation and learned something. If there's anything we could do, feel free to reach out. Let you guys get back to it. Have a great day. Craig, thanks for joining, and I'll catch up with you later.
Take care, guys.